Welcome to the 2023 open enrollment meeting. We're discussing the benefit plan year of January 1st, 2023 through December 31st, 2023. As a reminder, open enrollment is the one time of year that you can make a change to your benefits. When I say make a change, this is the time of year that you can add or drop dependents, or perhaps you want to change plans and you want to join the high deductible plan this year versus the buy-up PPO plan. These are all examples of changes that you can make during open enrollment. Please note the eligibility that's listed on the screen. For all full-time employees defined as by the company policy, and all eligible dependents, your spouse, domestic partner, and children up to the age of 26, regardless of student status and regardless if they are married. What happens if you need to make a change during the year? We've listed examples of the qualifying life events that occur during the year, such as marriage, birth or adoption of a child, if you or your dependents lose other coverage. These are all examples that occur during the year. If you have one of these examples that are called a qualifying life event, you must report that to People Operations within 30 days of your life event. If that 30-day window expires, you will have to wait until the following open enrollment to make any changes to your benefits. Alex is a great new tool available to you that can help you select which benefit plans are best for you and your dependents. Alex is going to ask you several questions to understand your usage of the various medical plans. I encourage all of you to try Alex at the link that we've provided on the screen. The great news this year is that there's been no changes to your medical plans. We are renewing with United Healthcare. All benefits are staying exactly the same. Today, we're going to be showing you in-network benefits. United Healthcare has a very large national network, and we encourage you to stay in network. There are out-of-network benefits, and if you are interested in those, I encourage you to look at the benefit guide. Let's discuss the first plan on the screen, the base plan HDHP, which stands for High Deductible Health Plan. Under the High Deductible Health Plan, everything goes towards the deductible first. So you have a $3,000 individual deductible, $6,000 per family. Once you reach that deductible, everything is picked up at 100% for the remainder of the calendar year, except for your prescription drugs. Those do have a copay requirement. Once you have paid the $3,000 out in your deductible, plus an additional $1,000 in prescription drugs for a total of $4,000 in your out-of-pocket maximum, your coverage will be picked up for 100% for the remainder of the calendar year. If this is your first time on a high deductible health plan, there are times that you may get a little sticker shock. For example, when you go to the primary care office visit, you're probably used to paying a $25 copay. Under the high deductible health plan, you're going to pay 100% of the contracted rate between that provider and United Healthcare until you reach $3,000 out of pocket. The next place that you might be surprised when you go in is going to be at the prescription drug level. As I stated before, there are copays after you meet the deductible on the high deductible health plan. $10 for tier 1, $35 for tier 2, and $60 for tier 3. If you're not used to being on the high deductible health plan, you go pick up your medication for the first time. You're paying 100% of that contracted rate until you reach that $3,000 deductible. The next two plan offerings are the mid-plan PPO and the buy-up plan PPO. The only difference between these two plans is the deductible and the out-of-pocket maximum. Everything else on these two plans are identical. Let's talk about those deductibles. On the mid plan, it's $1,500 per individual, $3,000 per family. Once you reach that deductible, you go into co-insurance level, meaning that United Healthcare picks up the remaining charges at 80%. You're responsible for 20%. Once you've paid out a total of $5,000 per individual or $10,000 per family, United Healthcare picks up at 100% for the remainder of the calendar year. The buy-up plan has a $500 individual deductible, $1,000 per family. It has the same co-insurance, so once I meet that deductible, United Healthcare picks up 80%. I'm responsible for 20% until I've paid $3,500 out per individual, $7,000 per family. That out-of-pocket maximum means once I've reached that level in network, United Healthcare will pick up the remaining of my charges in network for the remainder of the calendar year. Again, on the mid and the buy-up plan, the deductible does not apply to office visits. The office visits copay are exactly the same on the mid and the buy-up. It's a $25 copay for a primary care physician. If you have dependents under the age of 19, it is a $0 copay for both of these plans. The specialist office visit, as long as you're going to the designated network, it's a $25 copay. If you're going to the regular United Healthcare network, it's a $50 copay. When you go to myuhc.com portal, you'll be able to see those specialists that fall under that designated network for only the $25 copay. Preventative care, regardless of which plan you're on, including the high deductible health plan, preventative care is covered at 100%. Things like mammograms, well baby child checkups, annual adult physicals, flu shots, all of those things are considered preventative care. And as long as the claim is coded as preventative care, there is no out-of-pocket responsibility. The next item I'd like to discuss is inpatient hospitalization and outpatient surgery. With both of these line items, your deductible would apply on both the mid plan and the buy-up plan. If I'm going in for an outpatient surgery, going in for a CT, PET scan, ambulance services, anything of that nature, my deductible will apply on the mid plan and the buy-up plan. Prescription drug copays are identical on the mid and the buy-up plan. It's $15 for tier 1, which is going to be mainly your generic medication, $40 for tier 2, which is going to be some of your higher cost generics and then your preferred brand name. And then tier 3 is $75, which is going to be your more costly prescription drugs, going to be specialty medications, non-preferred brand name drugs. There is a mail order benefit on all three of the plans. You're getting a half a month for free. It's a 2.5 times retail copay if you take advantage of the mail order benefit. Where to go for care? Things have changed a lot in the past few years about where we go for care. And we just like to illustrate to you the differences here. Virtual visits, which we'll talk about in the next slide, is the cheapest place for us to go to care, regardless of which plan we're on. Then we have office visits, urgent care clinics. There's some great urgent care clinics in and around your area. With urgent care clinics, they can do a lot more than they used to be able to. They can do x-rays, they can do labs. And then one of the most expensive places for us to go is going to be that hospital emergency room. Those are going to be the ones that are tied and connected to that hospital. Of course, if it's a life or limb-threatening event, please go to the nearest emergency room. And then the most expensive place to receive care is going to be that freestanding emergency care. Those typically look like an urgent care facility. They are standalone, but they are the most expensive place for us to go and receive care. Virtual visits. Some people refer to this as telemedicine. Virtual visits is a great way to access care 24/7. You're able to talk to that doctor either by your smartphone or your computer. If you're on the high deductible health plan, it's only a $50 fee. If I am on the mid plan or the buy-up, there is no copay. We've listed the common conditions that can be treated through a virtual visit. The one thing to remember is that provider can prescribe medication. So if you're traveling for business or pleasure and you become sick, and it's one of the items listed here as far as the condition, then they can prescribe medication to you as well. It's a great benefit that you have. Also want to highlight some of the United Healthcare mental health extras that we have available to you. Talkspace is an online therapy that you can do through your phone or computer. It's available 24/7. There's no appointments necessary, but there are real-time face-to-face video visits when needed. The appropriate office visit copay would apply, or if you're on the high deductible health plan, that office charge would apply towards your deductible. Sanavella is also an access on demand app that can help you for stress, anxiety, or depression. It's available for yourself as well as any covered family member that is age 13 or above. And there's no additional charge for this. There's no copay associated with this service. It is an app-based tool. UHC Rally is a wellness program available to you online with United Healthcare. There are some new exciting changes coming for January 1st, 2023. You're able to receive some cash benefits. In the past, it's just been what we call the Rally coins. So for doing certain items throughout the UHC Rally website, you were given coins, and as you collected those coins, you could go to their virtual mall and go shopping. Now, just for completing that health survey and watching the video, you'll receive $25. If you complete a coaching program, you'll receive another $100. And if you go to the gym at least 12 times a month, they will give you $20 per month for that as well. So some new exciting changes. Again, these changes do not take effect until January 1st, 2023. Next is your medical rates. Fabulous news that these rates are staying exactly the same. There are no changes to your medical rates. So if you're selecting the same plan and you're having the same coverage level, you'll see no change to these rates for the new plan year. Next, we have a couple of claims examples we'd like to just show you. On this particular screen, we have an employee only who we call infrequent user. You can see they've had annual preventative care exam, a primary care physician office visit, a monthly maintenance prescription, meaning they take that every day of the year, 365 days out of the year, and an urgent care visit. We're showing you the base plan, we're showing the mid plan, and then the buy-up plan, and then the appropriate copays for both the mid plan and the buy-up plan. On the base plan, this individual has not reached their $3,000 deductible yet, so they're having to pay the appropriate contracted rate. And just a note on the monthly maintenance prescription, we annualize that cost. So that's why you're seeing $45 contracted rate, but on that base plan, you're seeing $540. We took that times 12 to get you an annualized picture. So total medical costs incurred, this line has everything you paid at the time of service, either copays, coinsurance, costs towards your deductible. Annual premium cost. How much did this coverage cost us? So if we go back and look at our paycheck and we take that amount and multiply it out to get our annualized cost, you can see on the base and the mid plan, it was $0 because we're covering employee only. On the buy-up plan, it was almost $1,200. Haven't talked about this yet, but if you're on that high deductible health plan, you do get $600 free cash money into your HSA that you can use to offset your medical expenses. So once we take all of this into account, we come up with that total annual cost. The next table down below is worst case scenario. You have been in a horrific car accident, you're in the hospital for a week, you're going to reach your out-of-pocket maximum. So that's what we've done in this example. On that base plan, it's $4,000. The mid plan, it's $5,000. And on the buy-up plan, it's $3,500. Again, we have to take into account that annual premium cost that came out of our paycheck. We take into account the free HSA money we're getting from our employer for that total annual cost. We have one more example, and this is for family coverage. So this is an employee who is covering themselves as well as a spouse and child. Same situation, employee and a dependent who is covered has gotten into a car accident and they both end up in the hospital for several days. They're going to reach their out-of-pocket maximum. So we're showing that out-of-pocket maximum cost there, $8,000 for the high deductible health plan, $10,000 for the mid plan, and $7,000 for the buy-up. Our annual premium cost, this looks much different. Again, we're covering not only ourselves, but we're also covering a spouse and child. And then if we're covering family, we're getting $1,200 into our HSA from our employer. And we add all of that together and get our total annual cost. Health savings account, also referred to as an HSA. If you are enrolled in the high deductible health plan, you may qualify to open up a health savings account. A health savings account is just that. It is your personal bank account, your personal savings account in your name that you can put aside tax-free dollars to pay for eligible medical, dental, and vision expenses for not only yourself, but also for your tax dependents. This account does not have any use it or lose it rules. The money accumulates over time and rolls over year to year. You are able to get tax-free growth of interest or investment earnings. As long as you're taking the money out for eligible expenses, you're taking that out on a tax-free basis as well. If you leave your employer, the HSA is your personal bank account, and you're going to be able to take that money with you. There are certain qualifications. You must be enrolled in that high deductible health plan, not covered by a non-qualified health plan, and this includes your spouse or TRICARE and or Medicare. If my spouse has a traditional PPO plan with copays and I'm enrolled in his or her plan, then I cannot be eligible for an HSA through my employer. And not participating in a traditional flexible spending account, and that includes your spouse. Your spouse cannot be in a traditional flexible spending account, and you have the HSA. That's considered double dipping. You can only have one or the other. The IRS sets a new calendar year maximum each year. You'll see that listed on the screen. You do have to take into account your employer HSA dollars. So we've listed what the employee maximum contribution is. You'll see that's $32.50 if I'm employee only, or $65.50 if I'm covering employee plus one dependent. It is important to note that if you are 55 or older, then there is an additional $1,000 that you can have as a catch-up contribution. If I'm on the high deductible health plan, I do have the opportunity to earn additional HSA dollars from United Healthcare. There is that opportunity if I am meeting the requirements of what they call FIT, frequency, intensity, and tenacity. You'll see the requirements listed on the screen. I can get up to $3 per day deposited into my HSA. That's up to an earning of at least $1,095 of free money that I could get into my HSA if I'm just completing these physical activities. Please note that you must register at unitedhealthcaremotion.com and activate your UHC Motion account in order for you to start receiving these dollars. If you're currently on the high deductible health plan today, this plan is active and you're eligible to start enrolling today in this. Healthcare Flexible Spending Account. This is another vehicle for us to put aside tax-free money to pay for eligible medical, dental, and vision expenses, not only for ourselves, but for any tax dependents. Please note that the healthcare FSA is only for those employees that are electing the mid-plan PPO or the buy-up PPO plan. For the 2023 plan year, you can contribute up to $3,050. This is a use it or lose it account. You're only allowed to roll over $610 into the new plan year. If you have more than that rollover amount, you will have to forfeit those funds. I encourage you to be very careful about the amount you put into your FSA because of the use it or lose it penalty. If you're getting towards the end of the year and you need some additional expenses to collect all of your money from your FSA, there are websites out there such as the FSA store where you can buy things like sunscreen, thermometers, blood pressure monitoring kits. All of those are considered eligible FSA expenses. So there are ways that you can use those dollars before the end of the year. There is also what we call a limited purpose flexible spending account. This is for those employees in the high deductible health plan, but the only eligible expenses are dental and vision expenses. Again, if I join the limited flexible spending account, the only eligible expenses are dental and vision. You can contribute up to the $3,050, but it is a use it or lose it account. You do have the rollover feature with this account as well. Dependent Care FSA. This is for eligible expenses for daycare, after school care, summer care, as long as it's not overnight camp. This is meant to be for expenses that are incurred while you and your spouse are working or looking for full-time work. If you are filing filing jointly as a married couple, you can contribute up to $5,000. If you are married but filing separately, you can only contribute up to $2,500 per year. The dental plan has a new exciting change to it effective January 1st, 2023. Implants will be covered now under major services. You have two dental plan options available to you. You have the base plan and the buy-up. The base plan has a $100 annual deductible per person with a cap of $300 per family. You have an annual benefit payout of $1,000 per person. On the base plan, there is no coverage for orthodontia care. So if you or your dependents are needing orthodontia braces, then you are going to want to look at the buy-up plan. The buy-up plan has a $50 per person deductible with a $150 family limit. You do get up to $1,500 per person for your annual maximum benefits. And then you have the benefit of the orthodontia care. Please note there is the annual maximum rollover benefit as well. We discussed this in the benefit guide. There are individuals that have some additional dollars to use in their account because they've been meeting this threshold on the annual maximum rollover. With the annual maximum rollover, we're encouraging you to use your benefits, go out and get those semi-annual cleanings done. And then if you don't reach your annual maximum amount on the base plan of $1,000 or on the buy-up plan of $1,500, you do have a rollover benefit that you get to roll over into next year to increase that annual maximum benefit. The rates have not changed. Exciting news here again. Your rates are staying exactly the same for your dental. Vision, there's been no changes to your vision plan. You have a fantastic vision plan that uses the VSP Choice Network, which is one of the largest networks in the nation. I do encourage you to stay in network like we do for all of the benefits. You have a very generous allowance of $150 for frames or $150 for elective contact lenses. And you have a very generous frequency. You can go and get your frames or contact lenses once every 12 months. So we've had this question with the vision plan. They're going to cover glasses or contacts, not both within the same year. So 1 year you can get your glasses and then next year get your contact lenses. Again, there's no changes to your premium deductions. These are staying exactly the same for the 2023 plan year. You work for a great company that provides you a group term life AD&D benefit of $50,000. Your employer pays 100% of this benefit. As you go through open enrollment, I do like to remind you at this time to make sure that your beneficiary information is up to date. Things happen within the past year. We may have a new spouse, a new girlfriend, boyfriend, whatever the case might be. Please make sure that beneficiary information is up to date. Your employer also provides you a short-term disability policy and a long-term disability policy. Another way that I like to think about these are income replacement. If I become disabled, how am I going to replace my income? How am I going to put food on the table, pay the bills? With short-term disability, if you become disabled, you'd receive a 60% benefit of your weekly income up to a maximum of $2,308. You'd start receiving this benefit after you satisfy the elimination period, which is 7 days. You could potentially receive this benefit for a maximum benefit duration of 24 weeks or until the doctor deems you're no longer disabled. If you continue this disability for 24 weeks, you'll roll into what we call long-term disability. At that time, it goes to a monthly benefit of 60% up to $10,000 per month. You've satisfied your elimination period of 180 days by meeting your short-term disability benefit, and you can potentially have this benefit to Social Security normal retirement age. You also have the option of purchasing additional voluntary life insurance. If you're currently enrolled in this policy today, then that coverage will renew as is, and you can just reelect during open enrollment. If you are a new hire, then the guarantee issue amount would apply to you. But if you're a current employee who did not elect initially, you will have to answer some questions of E of I, evidence of insurability. You'll have to answer some medical questions. Critical illness. Critical illness is what we call a cash benefit. You're going to elect a benefit amount from $5,000 to $25,000 in $5,000 increments. And if you have one of the listed illnesses while you're covered under the policy, they would give you that cash benefit back. So for example, if I elected a benefit of $20,000 and I had a heart attack once I was enrolled, then I would receive that benefit back to me as a cash check, and I can do with that as at my discretion. I could use it to offset my deductible. I could use it to offset my living expenses because I'm probably not working during that time. But that money is truly just a cash benefit that I can use at my discretion. Similar is the accident coverage. With the accident plan, you have the benefit of receiving a cash benefit if you incur an accident and have some of these services rendered. You have 3 options here. You have the value plan, the advantage, and the premier. With the value plan, your benefit payout or your cash benefit is a smaller amount, but also your premium that you pay in throughout the year is also a smaller amount. And then if I go up to the Premier, my benefit payout is higher, but also that premium that I'm paying out of my paycheck is going to be higher for the Premier. You can see that just in the accidental death dismemberment that's included. So if I die of an accidental death, under the value plan, my beneficiary gets $10,000. Under the Advantage, they get $25,000, and under the Premier, they would receive $50,000. The accident coverage does cover things like sports injuries. I have a teenage daughter who I typically purchase the accident coverage for because she usually is going to get a sprained ankle, a concussion, dislocation, something done throughout her career in sports. So the other thing to remember, these add up on top of each other. So for example, if I have a concussion, plus I had an x-ray done, plus I got some sort of medical appliance, I'm looking at $100 plus 30 plus up to $400 depending what that medical appliance was. There is a wellness benefit if you're currently enrolled on the accident coverage and you're getting those wellness things done, such as your annual adult physical, your blood work done, checking on your cholesterol. These are all examples that would qualify you for this $50 per year check to get back. Employee Assistance Program, also referred to as the EAP. You have a great EAP program that provides you 6 free face-to-face sessions per issue per year, not only for yourself, but for any of your covered dependents that are living in your household. The EAP can help you with so many different things. Maybe you've lost a loved one. Maybe you have a stressful relationship at home that you need some help with. Maybe it's that you have older parents and you need some help finding elder care for them. A legal issue, a financial issue. They even have a safe ride home. If you are, instead of driving while impaired, they're going to reimburse you for a cab or taxi fare. So a lot of great resources available. We're providing you with their 800 number and also with their website. New this year is pet insurance. Pet insurance is a great addition. We're providing you the website and the 800 number. This is something you're going to enroll directly with Pets Best. There's not going to be an enrollment through your online enrollment process. You are receiving up to a 10% discount on this pet insurance. There's several different coverage levels that you can select from. Do you want just emergency care? Do you want routine care plus emergency care insurance? So encourage you to go online and get a price, a quote for this coverage. With the pet insurance, you're going to take care of your pet. You're going to attend to them and their need and go to any vet. So if you already have that relationship with the vet, that's great. There's no network that you have to go to. And then you're going to file a claim and they're going to provide you easy reimbursement. You will need to go and log in to Hyliion, also referred to as Dayforce, to complete your enrollments. Enrollment is required. Every employee must re-enroll this year. If you do not go in and elect your benefits by Monday, November 14th, then your coverages will terminate. So I stress to you, please go in and make your elections. If you have any questions, please contact Leslie or Julie, and they can help you through the open enrollment process. Thank you so much.